Today we're going to be talking about rethinking SEP IRAs for court reporters. And I mentioned that working with court reporters, one thing I've seen is that SEP IRAs is one of the most common retirement plans that gets set up. But I want to talk today about why that may not be the best option for you and give you some other options to consider as well. So as we dive in, I'm Brandon Sussman, CFP and founder of Traction Wealth Management. So let's dive in. So first, we should talk about what is a SEP IRA. So a SEP IRA is a self-employed pension plan, and any account that has an IRA on it is usually one of the more easy accounts to work with, in the sense that the contributions can just go in whenever you want to. You can pause them whenever you want. So they're a little bit an easier account to work with. And so that's the nice part about it. And also they have one of the highest contribution limits available to anyone who is self-employed. So for 2025, you can actually do $70,000 into a SEP IRA. So it's nice to have that capacity to put in a lot of money into the account if you want to. One of the big inhibitors, though, is that the max contribution is 25% of compensation. And we'll talk a little bit more about what compensation means as well. So some of the key problems that I see with SEP IRAs, first and foremost, is that they're one-sided contributions. So what that means is that when you make a contribution to a SEP IRA, you're actually only contributing as an employer. You're not making any contribution as an employee. So sometimes you can get more money into retirement accounts because you may be able to do a deferral of your employee income and then also do some type of like match or profit sharing on the employer side as well. So you're doubling down by doing both sides of the coin. Whereas for a SEP IRA, you're only doing basically it's a profit sharing contribution into the account as the employer. So there's no way to do any type of employee contribution. With that being said, that also limits the ability to do any type of catch-up contribution. So pretty much every other account out there besides the SEP IRA does allow for a catch-up contribution once you're age 50 and over. And actually starting this year, certain accounts have another catch-up on top of that starts when you're 60. And because, again, that you're not contributing as an employee, there's no way to do a catch-up contribution on the employee side. So that limits the ability to do more money once you hit a certain age. There's also Roth limitations as well. And I'll go over this in a little bit more in a second. But right now, there really isn't an option to do a Roth SEP IRA. So if you wanted to be contributing some after-tax money into a Roth account, a SEP IRA isn't going to be a good option for you. And that also limits our ability to do a backdoor Roth IRA as well. So I won't go too far in the weeds today on what a backdoor Roth IRA is, but just to explain at a high level, you take money and you put it into a pre-tax IRA, and then you move that money into a Roth. You do a conversion, and it allows people who make too much money to be able to make a contribution into a Roth IRA. How the rules work with that, they look at every IRA that you have, and if you have any other IRAs out there when you try and do this backdoor Roth, it will mess it up from a tax standpoint and cause all these issues that you don't want to deal with. So essentially, the only way that you can do a contribution into a backdoor Roth is to not have an IRA, which means a SEP IRA would be off the table. And to talk a little bit more about the Roth SEP IRA problem, Roth SEP IRAs were actually approved as part of the Secure Act 2.0 in 2022. So that's a nice part, is that they were made available. The problem is that there wasn't any guidance on how they actually worked. One of the biggest issues, if you think about it, is that when you make a contribution to a SEP IRA, you get to write that off on your taxes on the business side because you're giving the employee a benefit. So you get to save on your own taxes. But what do you do now when that contribution that's going to the employee is after tax money and they were supposed to pay taxes on it. Do you pay the taxes for them as the employer? Do they get hit with higher income and a tax bill as the employee? There's just a lot of confusion there. So the Secure Act 2.0 basically just said that Roth SEP IRAs are allowed, but they didn't talk about all the intricacies of how it would work. And so because of that, even 3 years later, there's still no financial institution where you could set up a Roth SEP IRA. So hopefully that'll change in the future as they start to get more guidance on what's going to be available. But as of now, there's not really any options there. And so we're stuck looking for alternatives if you wanted to do any type of Roth contribution. The next piece I wanted to mention is going to be the W-2 wage trap here. And where this comes into play, and this is one of the biggest kickers I see in working with court reporters, is that a SEP IRA is limited to 25% of compensation, and that 25% is off of W-2 wages. So if you're incorporated, you have W-2 wages that you pay yourself, and then you also have the K-1 distribution, the owner distribution, and that income that you receive as well. The problem here is that you can only contribute 25% of your W-2 wages. And what most court reporters are trying to do is they're trying to lower how much money they're doing into a W-2 wage because they want to limit the amount of self-employment taxes, right? So you have to do what the government calls a reasonable salary that you pay yourself as W-2 wages, and then everything else we want to do the owner distribution. For example, you could make $200,000 for this year, but you're only going to pay yourself a salary of $50,000, and so your SEP IRA contribution, although the limit for the max limit for the account is $70,000, your limit's only going to be $12,500 because it's only that 25% of your salary. So it's a catch-22 because you want to put more money into the SEP IRA, but if you give yourself more capacity to put more money in there, that means you're raising your salary and you're paying more self-employed taxes. So it can be tough to figure out a balance there. And again, this is specific for anyone who is incorporated. If you're not incorporated, you're just a sole proprietorship, you don't have this issue because you don't have a W-2 wage. So for you, it's just your compensation after you subtract out your business expenses. So gross income minus business expenses, and then 25% of that is what you can add in. So what are some alternatives that you could consider for replacing your SEP IRA? So one of the main ones is going to be a solo 401k. Solo 401ks, a lot of people like because now you get to do an employee contribution and an employer contribution. So we just doubled the amount of money we're allowed to do because on the employee side, you get to do $23,500 into the account. And then the employer match is the same 25% rule. So the employer match, you can do another 25% of what you pay yourself as a salary. This does have the same $70,000 limit, but it is still hard to hit that limit. For example, let's say you are doing what I mentioned earlier of paying yourself a $50,000 salary. In that scenario, you'd be $50,000 times the 25%. So you could do an employer match of $12,500 plus the $23,500 here that you're doing as the employee. So employer and employee contribution. So that would allow you to put $36,000 a year into this plan. So it is higher, much higher than what you'd be able to do on the SEP IRA, but we still can't get to those like $70,000 numbers unless you really ramp up what you're going to pay yourself as a salary. So that can be a bit tough. The nice part about a solo 401k, you can have a Roth solo 401k. So now that option is available where you could contribute as an employee and do the Roth option. The only limit here is that typically most financial institutions only allow the employer match to be pre-tax. So you put in money Roth, your business is going to put in pre-tax. So it's not the best case scenario if you're trying to do all Roth, but it's a lot better than not being able to do anything into a Roth account. Another benefit to the solo 401k is that you can hire your spouse and you can pay them a salary and give them an employer match as well. So one example you could do here, you could pay your spouse exactly $23,500 and they do 100% deferral into their solo 401k. So they don't get a paycheck. They don't actually make any take-home money. You're just putting all of it into the 401k. And then you get to use that number, the 23,500, and do an employer match of 25% for them as well. So just for simple math, we'll say that they can do 23,500 plus around another 6,000 as employer match. They're doing about 30,000 on their end into the account, and then you're doing 36,000 for yourself. And this is all off my example of you paying yourself 50 grand a year. So now between the two accounts, you're doing about $66,000 a year into the solo 401k. And you could do all of that pre-tax and have that all be a deduction off of your income and lower your income by $66,000 for this year. So that's a great option to be able to do. There's also some other benefits, such as being able to offer loans in the 401k to take money out and doing catch-up contributions as well. That's even another piece I didn't mention of being able to do a catch-up contribution as an employee. So there's a lot of great benefits here. One downside to the solo 401k you have to keep in mind, though, is that you do have to pay for a third-party administrator to handle the paperwork. It is an ERISA plan, which means it's governed by different regulators. And the ERISA regulators require more paperwork to make sure that the plan is in alignment with the different laws that they have in place. So you do have to hire a third-party administrator. I found one that some of my clients use that are as cheap as $500 a year. So it doesn't have to be super expensive, but that is a downside to some people, is that in order to put all this money into this account, I have to pay $500 a year in fees to have the account managed by this company and handle the paperwork side of it. There are other accounts outside of the solo 401k, such as simple IRAs are good accounts to use as well. Or if you're not trying to contribute that much for this year, maybe you're only trying to do $6,000 or $7,000 this year. Another option is to just set up a regular IRA for yourself. You could do just a traditional IRA or a Roth IRA and contribute to those as an employee. And those are really easy to set up, and the limit's $7,000 for 2025. Just make sure that you do not have any retirement plans that you're doing through your business on top of doing the traditional IRAs or SEP IRAs. That can cause some problems in taxes, and also there are some income limits as well. So we want to be careful of that. So solutions and key takeaways. First, if you do want to do the backdoor Roth IRAs that I mentioned, or you're already doing that right now and maybe weren't aware of this rule, make sure you get rid of your SEP IRA before you do any more backdoor Roth contributions. You can move it into any account with a 401k title. So if you move that money into a solo 401k, that clears up a lot of those issues that you may have had. Another one would just be to review what you're doing right now, what you're planning to contribute, what your salary is, right? Some of the things I talked about today, do some of those calculations on your own and see how much you want to contribute and which plan is going to be the best fit for you. Also, if you wanted to look at hiring a financial advisor to help with these strategies and figure out what's going to be the best fit for you. And then lastly is just starting planning now. Maybe you're not doing the plan that allows for the most contributions, or you're not sure how much you're going to be able to do for this year. Just pick a plan and start it. Even if you end up at the end of the year where you're like, oh, I should have picked a different one that allowed more contribution, at least you were able to get money into your plan for retirement. And then next year, you could always figure out a new plan and start a new account going forwards. That is all for today. If you wanted to talk about this a bit further, I'd be happy to have an introductory meeting with you, and I can go through what you're doing right now or your income and what you want to contribute and see which plan is going to be the best fit for you. I'm happy to help where I can and talk a little bit more about my services. This QR code is a link to our booking page where you can set up that intro meeting. Other than that, I hope you all have a good rest of your week, and I'll talk to you next Wednesday.